now. So to begin with, I'm just going to go over something really basic with you guys. I'm just going to get some stuff out of my way. So hard. I don't know how you guys work with like single screens. This is really annoying. So I've pretty much deleted everything. For you guys who are in NBA, obviously you know my chart that I've already got going on BTC, but I've just sort of opened up to a brand new blank slate to sort of start clean and show some of these other guys what it is I do. So I'm not going to go into the real basics of technical analysis. The boys are going to cover that shortly. I'm just going to share my thoughts on what I'm seeing on BTC at the moment. So really what I've really been noticing over the last, I'm going to put up a date range tool. So looking from the bottom or the pivot low of the market from back in March this year after the sort of big COVID drop, we had a pretty extensive run. It lasted 175 days and we moved almost nearly 230% over the course of the year without any sort of serious retracement. So we just constantly, apart from that sort of hold up in the market where we started to squeeze and go sideways a little bit, we pretty much continually went up for 175 days. As we know, most markets sort of go in cycles. We go up, we go down, we go up, we go down, and it sort of just rhymes like that. Because we haven't had any serious or significant pullback yet, I'm still waiting for something to happen. You know, we didn't really get a strong retracement from this first push, and we ended up getting into a squeeze or a consolidation, popped up again, and then we had another consolidation through here. This time it was a little bit more sideways and ranging. And when it does that, we can start to draw what's called a Davis box, or you know, it's a consolidation range across two horizontal levels, and you can extend those boxes, you know, really far across. And these boxes just more or less become a point where market makers are basically trapping price both within, sorry, I got to quickly pull that up, trapping price within buys and sells, trying to keep it within a specific level. So we can sort of trade this range when it's in there. However, when it drops out of this range, this can sometimes be like a level of resistance when we come back up. So you can see we've fallen out of this box and started to consolidate and started to go on another bullish run up. But now that the bottom of this box now becomes a resistance level and we start to sort of headbutt. And that's now pretty much our indication of a rejection. And we could potentially continue down, which is what I'm sort of looking for. So overall in the market, I'm looking for a much bigger retracement than what we have. This is really just the start of the sell-off that could potentially start the downtrend that could be forming. But I'm really looking for a deep dive down below 8,000. So if we're going to draw Fibonacci levels from the bottom pivot from March all the way to the top, which was more of a liquidity grab when we popped out of that range around 12.5, when was it, back in August. I'm actually looking for a deep dive around this sort of liquidity area around here, even a little bit lower. I wouldn't be surprised if we do dip down to about 6,000, but really looking for a pickup in this golden pocket between the 50% retracement and the 618 retracement. So I'm sorry if some of this stuff is absolutely over your head. Don't stress too much. We'll delete it so it doesn't confuse you too much, and we'll get into some of that stuff a little bit later. Have to add some people in. So this big rejection we had out of this box, we've come down, retested it. I'm still pretty bearish overall on the market, and this is most likely just the start of market structure in a downtrend. So what we're looking for is continuous sort of lower lows, lower highs, another lower low, another lower high. Now we started to go into possibly a squeeze here. So we started to make higher lows, but still making lower highs. So I wouldn't be surprised if the next drop is quite small and we sort of get into a really, really tight range before another impulsive move out. So some people would be looking for a square up to possibly come up and sort of square up this level and go bullish. But looking at the leading edge, so what led into this symmetrical triangle is a downtrend. So I'd be more inclined to think that we're going to break to the downside of this, and that's where I'm looking for these low levels. A pretty obvious horizontal or equilibrium level through here. We're looking at this level through here. So this is most likely going to be a liquidity point that we would most likely see price fall out of this wedge and sort of hit this level, find some sort of support. But I still ultimately think this support will break and we will come lower down into this lower liquidity pull into that golden pocket. So this is kind of where I believe Bitcoin is sort of going over the next, let's see. So, you know, close to 2 months. close to 2 months. It might take a couple of months to bleed down there, but that's kind of where I'm looking at. Now, it could be completely wrong. We could actually bust out of this tightening range here to the upside. And if it does, that'll pretty much invalidate everything I've seen, and I'll basically have a completely new play. So it's sort of important to realize, like, when you are trading, it's important to have a bit of a roadmap or a plan on where you think the market's going to go, but don't just assume you're going to be right. It's just, that's your plan. And this is how I'm going to trade my plan. But if my plan doesn't go to play, I've got to think of a new plan, because obviously what I saw isn't going to happen, and I've got to look for something else that may actually happen. So this is kind of just drawing some trend lines on here now. This is kind of the squeeze that I believe we're going to go into. So we most likely come down and hit this line, pull up and get into this tight squeeze. And then at that point, someone's going to give up, whether it's the bulls or the bears, someone's going to give up, and we're going to impulse out of that move there. So the only reason I'm thinking more to the bearish side, if we do break out of this to the downside, is because we're leading into this symmetrical triangle with a big downtrend or a big sell-off, and the fact that we haven't retraced much over this last 6-month period, we still haven't really had a significant retrace. Now, a lot of people will sort of get scared off if we start dipping down around the 7,000 mark, but realistically, it's still quite a healthy correction in the market. Markets don't just keep going up and up and up. They'll always have that initial pullback or retracement level. So I would still consider this pretty healthy. So I'm pretty bearish at the moment. I've got a couple of short positions on from the top of this and the 618 retracement here, and I'll keep holding this as long as we keep moving downwards. However, if we do start to break out of this and make higher highs, it'll pretty much invalidate what I'm seeing, and I'll most likely close this and start to look for long positions, because there's a good chance we're going to keep going up for a lot longer. Now, something that I've been always paying attention to, because I trade a lot of global markets, is always pay attention to the DXY. Now, the DXY is basically the strength of the US dollar against the majority of the global market. So it's something that we should always really pay attention to, because it will have an effect on things like gold, silver, and Bitcoin. So we really want to pay attention to it. Now, what the guys in our team have been sort of really paying attention to is the fact that the US dollar had been getting hammered for the last few months, and we dip dive down into these low sort of 92 levels, 92. And we started to create what's called a V bottom. So we started to like have deep dives, but quick buybacks. And we started to form essentially like a inverse head and shoulder pattern. It's a little bit skewed, but what we do see is a pretty clear neckline. So what we're looking at is our left shoulder down here, our head pattern down here, and then we formed a right shoulder. So what I'm actually looking for is that impulsive move, if we break that neckline, to head back up to pretty much where that previous resistance will be. Now, when we were looking at this a couple of weeks ago, we're actually back down in this right shoulder, and that was pretty much the decision point for me. I was basically saying that if we head up from this left shoulder, from this right shoulder, we're looking to break this neckline and retest. If we do get a clear retest on this level, there's a good chance the US dollar is going to gain traction again. And this all sort of coincided a lot with the US election and stuff as well. There's been a lot of hype and drama around that sort of area. So we're expecting sort of a run up on the leading up to the US election. However, if we didn't sort of have that retracement or pullback from that right shoulder and actually broke the right shoulder, would see us dip dive down to about 90, into sub 90, which would have seen the adverse correlation on Bitcoin. We would have most likely see the price of Bitcoin skyrocket out of there. So this could have a really big effect on this symmetrical triangle playing out. So, if the US dollar actually falls back through this neckline and goes bearish again and starts dropping, we'll most likely see Bitcoin break out of this symmetrical triangle and start heading upwards. However, vice versa, if what we've already got here is a bounce on this neckline, so that's our break and retest, this sort of gives us a confirmation that we may actually continue to go up. If we do continue to go up, that'll probably see this symmetrical triangle break to the downside, and we'll probably start heading down a fair bit, which is where we will most likely profit most on the short position. So, guys, hopefully that wasn't too much of a headache for you guys. For you guys who know a little bit about the market, a lot of it probably made sense. Some of you guys who are new here probably wouldn't have made a lot of sense. But I'm going to hand it over to Shams and John now and get them to just share a little bit of basic stuff with you and see if you can get your head around some of this stuff.
Perfect. Thanks, Matt. Do you want to enable screen sharing for me?
Certainly can. Go for it.
All right, so let's jump in. Have a look, move that over there. Now, what we're going to go through, and let me just bring up with XBT, just because it's a bit easier to go off. So what we're going to teach you guys is the first thing that we essentially use as kind of the foundation for technical analysis. Get rid of all of that. This computer's a little bit slow today. I do apologize, guys. So just to get a quick gauge of everybody, who here has no experience in TGA? Who here kind of doesn't know what we're looking at, except that it's a bunch of little green and red lines and then lines we draw on the screen? Is there anybody that's brand new?
Yeah, me.
Perfect. Anybody else? Everybody here got a little bit of experience? Just to kind of gauge how I'll share some of this. Everybody's quiet tonight. Okay, well, I'm just gonna base this off the fact that potentially we have some people that have no experience, and we'll just go off. So the first thing you're gonna learn is support and resistance. Now, support and resistance are essentially levels that you kind of see price come back to, and Donnie had these highlighted with the diverse box he did. You kind of see price was respected, and I'll zoom in a bit more so it's a bit clearer. You can see that price kept coming back to this point, kept getting rejected. So these are the closes that respected. Then we've got some wicks, and when we came on the other side, it got respected from underneath. Now, what we say in trading is what is once resistance that gets broken turns into support, and what was once support that gets broken turns into resistance. Now, a common thing that I see with a lot of students kind of submitting their homework is they will look for those levels that were previous highs to mark resistance. And as soon as we break through here, they will forget to kind of look at those previous support levels as new levels of resistance. Now, like I said, when you break one of those levels, it always becomes resistance or support from the other side. And I guess the best analogy I have for this is we kind of almost use this to represent a multi-story building. Think of this being, let's say, the 23rd floor. I'm going to draw 23, and you're kind of standing on this point. Now, all of a sudden, this is your floor underneath, and let's say you've got another, actually just use my horizontal. You've got another level above you, that's the roof, and that's a level of resistance, and this is a level of support. Now, if the floor breaks and you kind of fall back down, and now you're standing on the next level of support down here, what was once above you as the floor that was support is now above you as a roof of resistance. So with trading support and resistance, it's generally almost like a little step ladder that you kind of work your way up and down. So you've always got to remember that even though the level of the swing was up here, potentially that's still going to be not the closest resistance we need to consider. So when we're looking at market like this, and what we can do is I'll go back a little bit and kind of show you how this works. Let me clear all that to make it a little bit easier. We'll go to a different point. Okay. So what I'm going to do is we're going to mark off some levels. So imagine we've got, we'll just go from there. I'm going to mark off the level. So we've got one there, another one here. Now marking off levels where you kind of see bodies coming close to, and you can see we got it respected nicely here. We have another one about here because we've got some nice clean touches and respected over here. And another one up the top here where we've got wick, bodies, wick, and respected up here. Now you can see that I've got 4 levels here. And what we're going to do is just press play to kind of just have a look and to see where the price kind of bounces between these levels and how well it's respected. And if everything kind of goes according to plan, we've got a nice little test there. You can kind of see, oops, stop this computer.
Yeah, it's really jolty, man.
Yeah, I think I've got problems from having it on all day and 3 screens that are running too many things. Let me close a couple more things down. Is this Chrome or Safari? Cool. Let's get rid of Chrome. There we go. So as you can see, when we started down here, guys, we had price come up, it broke through, and you can see over here that it came back right to test it. We came up, we came through, we retested, and we kind of got stuck on this level. Where did we come up to? The very next level. And exactly the same. So you kind of see that with price action, you really just end up being almost this little like step ladder that follows its way up support and resistance, which is why when we're trading, this is really the king and queen of your technical analysis. It's your foundation and kind of what we use to gauge the strongest levels that we want to base our trades off. But that is the first thing. John, did you want to go through trend lines and market structure potentially?
Yeah, I'd be super happy to go through trend lines with everyone.
Go for it, mate.
So what I'll do is I'll just
Too much fire.
let's go.
Yeah, mate.
So guys, for all the people who don't know what trend lines are, trend lines is pretty much like a level of support and resistance, but it's like a diagonal line. And it kind of just helps us determine whether the market is moving up or whether the market is moving down. And one of the biggest mistakes that I kind of see students make and new members who start trading make is that they tend to draw their support. I mean, they tend to draw their trend lines on the opposite side that it's supposed to be on. So I'll give you an example that I kind of like to always use with new students. So what I tell students is when the market is on its way down, you want to be able to have the trend line on the bottom, so along here, instead of at the top. And I'll explain to you guys why right now. So if you were to understand trend lines, it's just you need 2 points to draw it up. So you just need 2 points of a high or 2 points of a low to connect it. And a third point usually confirms it. So I'm just going to pick this point here. I'm going to extend it over roughly like so. And then I'm going to do one with the one at the bottom as well. So the point there, extend it over like so. So as you can see here, these are two trend lines. And they're both drawn in correctly. They both have 2 points with a third point to confirm. And you can kind of see how it ranges in this downwards channel. The biggest problem with beginner traders is that sometimes they only like to draw the bottom ones, or sometimes they only like to draw the top ones. And this is the analogy that I use for new students. So based on the two lines that we have, we can safely assume that every single time price touches this top line, it gets pushed down. Touches the top line, gets pushed down, touches the top line, gets pushed down. And then it's also safe to assume that every single time price touches the bottom line, it gets pushed up. As you can see, it touches, gets pushed up, touches, gets pushed up. This also comes into the idea that the trend is your friend. And this is why I say that when the market is going down, you want to draw it at the top and not at the bottom. This is the reason why. So if you were a brand new trader, you had no idea what you're doing in the market, you had no idea of stop losses or take profits or anything like that, but you knew trend lines. You just knew that you could draw a trend line and attach them to kind of dictate the direction of the market or predict the direction of the market. And you were to draw it from the bottom like so, and you would buy into position hoping that price would go up. So let's say you're a brand new trader, you bought in right there, and then the price is going up. You head out, you check your price on your phone and you're like, oh, awesome, I'm in profit. And then what you do is you head out, you have a couple of drinks, you party, you wake up the next morning super, super hungover, and next thing you know, you're in a complete loss. Because you assume that by following this trend line, which was correct, and the price pushes up, you'd be in a safe position. However, as you can see here, that would have led to a loss in asset or a loss in value. The exact same scenario, you're a completely brand new trader, novice trader, no idea what you're doing, no stop loss, no take profit, no real knowledge except for the trend lines. And you entered in a position here for it to go down, and you just followed the trend is your friend idea. Same deal, the market goes down about here. You quickly check your phone, you realize you're in profit, so you decide to celebrate. You're drinking, you're partying all night, you get hungover, you completely forget about your trade or what you're doing, and somehow you wake up in the morning in profit. And that's just the difference between drawing the trend lines on the correct side. Another great thing about trend lines is it can actually help you determine when the price or when the structure of the market changes if drawn on the correct side. So for instance, if the market's going down, sorry, wrong line. If the market's going down, you draw it from the top. So market's going down, draw it from the top. Once you see the break in trend, it signifies and tells you that there's a possible change in market direction. So what that allows you to do is draw that second trend line over the side. And you can see now price is following that trend line until it breaks, and then you just repeat the process again. So from the top down, see the, oh, that's a bit skewed. See the top down, something like that. There we go. Once you see that break, you do it again. Once you see the break, you do it again. And just by drawing trend lines correctly, you can see that this has guided the market down. Once it broke, our second trend line guided the market up, guided the market down, guided the market up, and so forth. So just from support, resistance, and trend lines, those are pretty much the only two real strong lessons you need as a novice trader to actually enter the market and be profitable right away.
Thanks, John. Easy.
Shams, you want to touch on not so much just the trend lines, but more so on market structure, like higher highs and higher lows?
Yeah, can do. All right. So pretty much the last thing that kind of ties this all together, guys, is going to be market structure. So it kind of goes hand in hand with the trend lines that John was just going through. Let's draw one in. Get rid of these for now since we don't need these. And what I'll do is replay it to about there for now. Okay.
What I like to do in this instance, Shams, is maybe put on the line chart just to avoid any confusion from the noise of the wicks and stuff like that.
We can do that.
Yep.
You messed with my trend lines then, mate.
Sorry, bro.
That's all right. All right. So this is just a different way to display price action, guys. Line charts essentially just show you the closes of price action for that day to mark the points. Now, in terms of what we're looking at when we're looking at market structure, is we're trying to get the same sentiment that trend lines give us in terms of whether we think the market is going up or the market is heading down. And the way we do that is by essentially labeling things as higher highs, higher lows, lower highs, and lower lows. So what we mean by this is we're looking for those points in market where essentially price started to swing around. So you can kind of see like here, price was heading up, it swung up, came down, swung up, came down, swung up, came down. And you can kind of see that this was the pattern, removing all the extra little noise we had. I did it, of course I did. So let's quickly do that again. So you can kind of see that's the pattern that price took. Now, what we want to do is look at those points where essentially we had swings to mark those changes in market structure. So if we start down the bottom, let's say this was our, this was our lowest point. So this was, let's say, the low. So just one L. What you're looking for to mark the points underneath is you're trying to see whether this low was higher than this low. If it was, you mark it as a higher low. Then this would be our first high. So we'll put that as a H. And then what we've got is we look at the high on the other side of that to see whether it was higher than the first one we've got marked. And if it was, we label it as a higher high. Then we move to the next one. So this high was lower than this, so it actually becomes a lower high. This low was higher than this one, so it's still a higher low. And what we're looking for is while we're creating higher highs and higher lows, it's the same as looking at that trend line. Essentially, we're in an uptrend. Now, the moment you start seeing it shift the other way, that's when you start getting your warning signals to tell you that potentially we might not be looking at things the same, like following the same direction. So when we get the lower high, that's your first one, but you really want to see the next low being lower than the other low to create a lower low. That confirms we're starting to get that change in market structure and to get you out of positions potentially earlier. So if you were bullish and you held along through all of this, well, that first lower high would have been your first little warning signal to tell you, watch out guys, this might be turning around on you. So after that, we kind of look at the next marks. This is a lower high to this previous lower high. So it's still the same. This low is pretty much the same. So it's not a lower low or a higher low. So we just mark it as a low again. But this one is higher. So we mark this as a higher high because this high is higher than the previous one. And then we just kind of come back down. You can see we made another a higher low, then a lower high, lower low. You can see price just getting squeezed. Essentially, we use market structure in combination with trend lines to start gauging when we're getting those changes in direction. So yeah. Anything else you boys want to add to that?
No, that's good, bro.
Easy. So that's a really quick crash course, guys.
Can you unshare your screen for a sec, man?
Yeah.
I've got something ready here. So this is something that I used to do ages ago with a lot of the students, and I just started doing it again on Friday's lesson, and everyone really enjoyed it. So I'm gonna have another crack at it now with you guys. I've just got this chart ready here on XLM. Now, just just learning off the very, very basics of what the boys just showed you, which was market structure, trend lines and support and resistance. What we want to do is build a chart here right in front of you guys, and then basically press play and see how we go on it. So the first thing I want to point out, or I'm going to ask you guys, is what do we see at the bottom here? Like what's actually happened? We can see a really long downtrend. We're on the 4-hour chart, by the way. And then what's actually happened? So we're making consecutive lows, lower low, lower high, lower low, lower high, lower low. Then what's actually happened? We've started to do something different. So I'm just going to bring up the chat. And the chat's disappeared on me again.
So Michael said a higher low. Paul said change in market structure. Another higher low, higher high, higher lows.
Okay. So we've had a slight change in market structure. So we've been on a downtrend. Now all of a sudden we're essentially on an uptrend. So the first thing we're going to do is look, we've already identified the uptrend, the high highs and high lows. The next thing we're going to do is probably start drawing a trend line. Now, as Shambo mentioned before, and actually as John mentioned as well, the two touches, so I use wicks to wicks. Some people use wicks to bodies, bodies to bodies. But regardless of whatever you use, if we're going, say, wicks to wicks or body to body, we've got two touches. Now those two touches set the trend. So we actually draw a trend line in like this, but until we get a third touch, we haven't really confirmed this trend line. So we don't really know what's going to happen yet. We've got a potential trend line there. Let's wait and see what happens. Now, what we can do in this instance, let's say we have confirmed the trend line and we do know what the trend line is. Like, okay, what do we do now? Now we know a trend line's there. How do we trade it? There's a couple of different ways you can trade a trend line. What would be, I'm going to ask, because obviously there's a couple of our students on tonight. I'm going to ask, what's two ways that we could trade a trend line? Two types of trades. My chat just keeps disappearing, which was really annoying. There we go, it appeared again. So two different types of ways, short, long, yeah, okay, mill arm, perfect. So continuation patterns or continuation trading. What's another type of trade we can do off a trend line? Trend trading, yeah, it was with continuation. Breakout, Michael, perfect. So a break in trend. So there's two different ways we can trade a trend line. We can trade on top of it, or we can trade a break of it. So a continuation or trend trading would basically be going, or assuming that we're going to keep going like this. Bang, touch, we'll open up a position to go long here, and we continue to bounce up. You know, bang, we take another position here, and we just keep trading it up. Now this is called continuation trading, because we're going to assume that we're going to continue to make higher highs and higher lows, higher high, higher low, so on and so forth. And as long as we keep continuing doing that, we can pretty much keep placing trades on there every single time, over and over and over again. However, that's not going to continue forever. Eventually the trend breaks, because we've got to think of this as like a resistance. If it was horizontal and that was support, if that was horizontal and it was support, you know, we're going to essentially keep coming down and bouncing off this horizontal line. But eventually, you know, eventually that line breaks. Eventually the support breaks. If you hammer a support level enough, it'll eventually break. And the same theory or analogy applies to a trend line, because it's essentially a support on a slight angle. So the more times it touches, eventually it's going to break. And once it does break, we've then got a change in market structure. We're essentially going the other way now, and we could look to short the market. So here's our continuation trading, taking a position on here, taking another position on here. However, if we come and break through this level here, then what we're looking for is to actually trade the market down. So sometimes you can wait for maybe a retest, or there's might be a significant level that you look to actually get into the market once you've confirmed the break-in trend. And now we're actually assuming that we're going to continue down that way, and we're going to start making money on the way down, which is essentially shorting the market. So there's two ways we can trade this trend. We can either long it off the trend, or break it if we break the trend, short it if we break the trend. So what we're going to do now is we're going to press play and see what happens, and then we're going to make up our mind what we're going to do. If I speed this up, it'll go too fast and I'll miss it. All right, we're getting pretty close. All right, so there's a perfect touch. So right there is basically a point that we can open up a long position. Now, if we were going to open up a long position, where would you guys think we're going to trade this to? So let's do a setup and let's do a trade. We're going to do a long setup here. Let's going to say we enter this position here. Where are we looking to take profit and where are we looking to put our stop loss? So we'll start with our stop loss. Where do we want that?
Mark just said previous high.
Previous high for the profit, maybe.
Below previous low, below wick.
My chat keeps disappearing, so I can't see what they're saying, bro.
Leanne saying below the previous low. Yep.
Something like that. So we've got a risk to reward ratio of 2.65, which is nice and healthy. And you can't really, can you guys see that? Or is it like really, it's really dull, isn't it?
2.65.
That's what I'm going to do. I just got to make it a bit brighter so you guys can see it. And the red, make it a bit there. There we go. So you guys can see that a little bit better now. So something like that. And what do you say? Where are we going to take profit?
We had 900, I think was one, 920.
920. So you're looking at maybe that peak there. So we're looking at that close. So
and Richie just raised one thing. Can you draw that upper trend line in terms of what John was saying that could potentially help you gauge some potential targets?
As in this trend line?
The parallel channel.
Oh, okay. So drawing a trend line above, like this.
Yep.
Yeah, if we did a parallel channel, it'd be something like that. I still wouldn't be getting too greedy trading this continuation. I'd be looking to, yeah, most likely close. We've got this not only was a previous close, it was also a resistance through here. So this becomes an equilibrium that we'll probably be attracted to. The price would most likely be attracted to. So that'll pretty much be our trade setup. Now, if this gets invalidated and breaks through this trend, then we're completely flipping our bias and going a different way. So we'll push play now and see how that goes anyway.
Oh.
All right, so bam, there's our trade. So that was we're on 10x or something like that. So that's a 75% profit trade. So that was pretty much one and done. And that would have taken only a couple of days to play out. So that was a pretty good one. Now, what are we doing now? We're going to look to take another long position here. So we've had one, almost two there, 3 touches, going for a 4th touch. Normally after say the 5th touch would probably look to look for a breakdown of this trend. But let's just keep going and see what actually happens. See if we're actually going to take another long position or what. So now coming to what's called a squeeze. All right, so now we're starting to walk out of this trend line. So that was our previous support. It was on an angle, but that was our support level. We've now broken below it. So now our bias is changing. Instead of thinking this is going to be a continuation trade, now we're actually looking to short the market and make money on the way down. So you could basically take a position from there. Sorry, I jumped the gun then. So we could take a position on that retest here. Now our stop loss, you'd probably want to make sure your stop loss is above that previous structure here. And then where's our target going to be? Where are we looking to short this thing to? What I'd like to see is maybe a couple of take profit points as well, rather than just a final target.
Zen saying fibs, a couple of people saying 0.
0. They've been watching my calls too often, obviously. So fibs, we can pretty much draw from the pivot low up to the pivot high here. And you're looking for a retracement down to these fib levels. So maybe the 618.
760, one person said. We've got Paul Van Ross.
I'll start drawing some levels. 760 all the way down about there. 760 looks like a pretty good target. So the reason I like that target, who was that? Sorry,
Paul.
Paul. The reason I like this target is if we just go a little bit lower, that's probably about as low as you would think that the market would fall. That's pretty much 100% retracement. And the fact that you pull up a bit, that's because you're not getting greedy. It's not ideal to always be greedy and try and catch the very bottom, because there's a good chance you miss the bottom by a couple of bucks and end up missing the complete trade. So something to be wary of, and yeah, always be a little bit more conservative on your targets rather than trying to catch every single bottom dollar, because you'll miss by a couple of percent. Now the other level I really like through here is about there, just because it was a major support level, support resistance level through here throughout that period of time there. So that's another level that I'd probably consider managing this trade or taking profit, as we might run into trouble here. So what I mean by that is we may start to come down, but we may hit this and we could start to go back up. So if you don't take action at this point and you take your entry for a short position here, we could come down, bounce off here, come back, and you could end up losing money, or because you didn't take action at this point that could have been a real problem area. So you've got to identify those potential points that could be a problem for you. So just because you think this is going to happen, you're an idiot if you sit here and let this do that and not ever take action at this point. This should be the point where you adjust your position and secure your profit, minimize risk, and so on and so forth.
So Paul's just asking how much you would take profit in a situation like that, Donnie.
Yeah, so for me, if I had two potential areas of interest like that, I would be inclined to maybe take 50% or close 50% of my position at that point and adjust the stop loss on the other half to be break even. So essentially it's a no loss trade. And then you can sort of just go on with your day and know that you're not going to lose money. Otherwise you could do maybe a 25% close, a 30% close. Like, it's really up to you as an individual. Me, if I had two points like that, I'd probably close 50%, adjust my stop loss and let the other 50 run to my final target, and I'd leave it at that. But yeah, everyone does something different. So we're going to push play now and see how this plays out. So just fell short. You can see how that level did act through a perfect close on that level there, and we pretty much closed on that level as well. So I think the market did keep going a little bit further here. So you could have potentially made even more profit if you had a run, say, trailing stop losses. But the fact was, this was what you saw and this is what worked. But you can also see how both those areas that we chose ended up being potential points that we did hold up the market, and we could well have retraced at those levels. So it's something we really need to be mindful of. However, it would have worked perfectly. We would have taken 50% of our profit here, another 50% there, and basically secured that whole trade. So yeah, good one.
Donnie, just Brendan asked a quick question. He asked, would you move your stop loss with the trend?
With the trend as in...
I'm guessing that means almost like a trailing stop loss there, Donnie.
A trailing stop loss, yeah. You can use things like ATR. ATR is really good for using trailing stop losses, which is basically a free indicator. So if you come into indicators and choose ATR, which stands for average true range, and you can overlay this. Actually, can you overlay this on the chart? There we go. Doesn't quite work that well. Okay, hang on. So how am I going to do this? So what I can do is put this on. Just give me 2 seconds while this loads up. Wrong one. Okay, so what you can use, this is essentially an ATR. So this red line above here, this is using an average true range, which I guess is kind of what you're asking. You could pretty much make this red line your stop loss. So what I'll do is I'll replay this again. So I'll just move this back. Hang on, sorry. I'll just move this back to say here. All right, so let's say you got into this trade and that red line here, actually I'll change that to red so you guys can see it. Make it a bit bigger. So that red line there is your stop loss, right? There's a little red wick there. As we push play, that red line is going to follow down, and I could pretty much see how this red line there, I know I'm not doing a very good job of it, but essentially you could leave that as your stop loss and just keep following it down. All right, and I'll just keep playing this through so we can see how eventually it will turn on us. So let's say you didn't close this trade and you just ran stop losses. You would still be in this trade. You'd still actually be making, let's see, I'll just bring this down and see how much profit you'd be in. You'd potentially be in 26% profit. If we're 10x, that's 260% profit already. Still coming down, still following. All right, bam. Right there is where you would have been stopped out. So by using the average true range, you can pretty much use it like a trending stop loss, if that makes sense. So you would have stayed in this trade the whole time until basically here, when the trend had flipped, and now the average true range, if you're in a long position, your stop loss is now actually going to be here on the upside. So that's a really handy tool to use if you're going to start using trailing stop losses. But trailing stop losses can be really, really tricky, especially if you're on tight, like shorter time frame markets. And if you're running tight stop losses and you're not looking at overall trends, they'll generally smash you out, because you've got to get a little bit creative with the distance that you put behind it. And most trailing stop losses on most platforms are either dollar-based or sat-based in terms of how far away, not so much percentage-based. And even then, ATR isn't necessarily a static percentage number. It actually changes depending on volatility and price action rather than a whole number. So you can see here, like for example, the distance, if we're going to talk sat price or dollar price, the dollar price between the candles here and the ATR there is different to say the dollar price here and there. So it's fluctuating scale. So an ATR, unless you use bots, so like with the program that I run, you can actually trigger your stop loss based on the ATR. So that way the ATR is always fluctuating. TradingView knows the algorithm. And if the ATR gets hit, it can then send the API signal to the exchange to close your trade. However, most platforms like BitMEX and Binance and stuff don't have those sort of features. So you can't really have that fluctuating scale. You're only going to be able to do a dollar value or a percentage value. And like I said, using dollar value or percentage value, the price fluctuates too much. You'll get hit. You'll probably get hit, you know, here. You'll get hit well before the ATR does. So ATR is a much better way of doing it. But unless you've got any sort of experience with coding and automation, you've literally got to be there watching it and manually do it yourself, which gets pretty tricky.
Because ATR will essentially measure how much the movements have been in the last X amount of candles. So if you have a price action that's very volatile, guy, you'll essentially have a higher reading, which means your ATR will be further away. But it could just be due to some very recent price action that's very volatile, and then it kind of blows it all out of the water. So the bigger the candles you get, the bigger the gap, which means you could just have a stop loss that's way too far. Or if price has been very quiet for a bit, as you get it when you're getting squeezes, and when price gets squeezed and the volatility is low, and then you've got your ATR too close, as soon as that impulsive move happens, you might get stopped out before it potentially goes the other way.
Yeah.
And Donnie, before you move forward, or when you do decide to, could you maybe show us why price decided to turn there?
Yeah, sure. So I'll just quickly show you here. So there's only so let's say you were running your stop loss on a basis of 2.6%. And just kept that static number like that. You can see here, there, you would have been stopped out, because if you had a static number of 2.6%, you would have been stopped out there easy as. So you couldn't have had that static number, if that makes sense. And then if you look here, the distance between there and there, yeah, you're talking about almost a 10% distance between your stop loss and the actual current price. So if you had a numerical number of 10%, you would have literally been stopped out 2 candles later at about 6% or something like that. So this is why you can't have a static number. So using ATR, even though ATR is actually incredible at finding those sorts of levels, especially on very well trending markets, it's almost impossible to have that predict your stop loss without automation and coding. And obviously it's not that easy to do that. So John, you just asked, why did we turn around here? All right, so this is a good one. Let's just put that there. So this horizontal ray is virtually just a straight line that just follows price action for ages. So what we're going to do now is going to go back in time. We're just going to go left. You always look left and see if there's any other significant point at this exact price point, 604, that could have told us earlier why we would have turned around there. So virtually what we do, I don't even know if we actually do that, but let's go have a look.
Maybe jump on the daily as well.
Yeah, probably wouldn't hurt. Oh, there we go. No, we didn't. That's pretty much new lows by looking at it, bro.
All-time low.
Yeah, it's all-time lows. So you haven't actually got any data to work with there. Actually, looking at the ATR on the daily, you can see we're actually just turning up, and we're actually at a point where it could actually switch the ATR bullish, which means we're actually on the beginning of a new potential uptrend. Who knows how long that'll last. So the only other thing that I would have used there, John, would maybe be Fibonacci extensions. but on the daily, it looks pretty cooked, to be honest.
Yeah. So I guess this was kind of a bad example of support and resistance, but maybe we could use the line just above it to show why price had stopped there initially before continuing down. Yeah.
So that one there.
Yeah.
So if we go back to the daily chart, so if you were wondering like why when the market was trending down for so long, why did we stop here and start to go up? Well, if you go back in time and have a look back in December the 9th, 2017, that was actually a support level. So you can see like almost nearly 3 years later, that level is still significant.
And the reason why a level is significant, guys, is because everybody sees it as a level. The reason the support level keeps getting priced back to is because this is where price historically has been respected. And if we sit down in front of the computer like any other trader, those are the levels we're all seeing, and those are all the levels that we're all using. So that's why the more times a level gets tested and respected, the more strength it has, and the more likely it's going to be a level that gets held. Yeah.
So you can see here when we came down, the market sort of tested these areas and started to head back up. If we go left, you can see here we've actually hit those levels once before. You know, just continually. Support and resistance is just, you know, there we go here. We bounced here, we bounced there, we've bounced there, we've bounced there as an inverse head and shoulders. So they're always fairly significant. Shams, did you have one that you wanted to run through?
Yep, you can do that. All right, so we've got this. Get rid of those drawings.
Yeah, too easy, Beck. I'll message you later.
So let me bring up the chat to make sure I'm not missing anything. All right, guys. So first off, we're on. Let's start on the day. Let's start on the daily because that's where we start our analysis generally. And I want you guys to tell me potential things that we're looking at and kind of what you're seeing, where you want me to put some levels, and we'll go from there. So just covering what we've obviously taught you, and then for the students. So we have a bull hammer forming. Yep. What else do we have, guys? Joel saying fibs. So Joel, you're saying theta and fibs. So probably saying fibs from that to that, you're saying? Yep. So we obviously came back and tested the 618. So for anybody that knows the way I trade, if it bounces off the 618, where's my first target? 236, nice Milan. Just mark that there just in case. All right, but what else besides fibs, guys? Go back to the basics. Whoop, come on, where's the line? I'm just gonna mark that as the 236.
Guys, I just wanted to quickly mention for all you guys in NBA, it's 8 o'clock. So some of you guys might want to be going to jump on a Jace's call about now.
Yep.
So I've mentioned that.
Cool. So let's see, guys.
Get your butts kicked.
Yeah. Support resistance. Where are we putting support and resistance? Start with that. Resistance at 6,000. Thank you, Ashley. So 6,000, you're saying probably about there. And we've got support at 46. So you're saying about there. Yep, perfect. All right, now, since we got that marked, if we're looking at market structure, guys, what do we see? Trend lines and market structure, what does it tell us? What's your bias at the moment looking at this on the daily? Change in trend. So if you're saying a change in trend, we'll draw a trend line going down. So we'd say something like that. So 1 touch, 2 touch, 3 to confirm. And now we've had a break of trend. So that's our first suggestion. But in terms of market structure, what are we seeing? A higher low. So we haven't confirmed this as a potential higher low because right now, if the next candle becomes a big red one that comes down all the way down here, essentially this could now be just a lower low. So we really have to confirm a swing for it to be that change in market. So we've got a higher high. So you're saying this is a higher high. But if this is a higher high, where's that previous high that it's higher than? So if we're looking at this is on the daily. So if we're looking at market structure on the daily, I kind of see this as the move we've had. And if that's the move we've had, If this was our high, this was our lower high, this is actually still a lower high. So we'll get rid of these. So this is where we start getting pieces kind of all together. So we've had the break in trend. We still have market structure on the daily that suggests we haven't had that kind of like confidence to say the bulls have really stepped in. We've had a nice break and we've come up to a nice level. Obviously we've got tested before here. You can see some nice structure. So what we'll do is we've got a trend right now. We'll jump down to the 4 hour and see what we can see on the 4 hour. So on the 4 hour, what I'll do is get rid of the 236 level for now. Actually, we'll leave that there for a sec. No, that can go. We don't need that. That's not relevant. So on the 4 hour, guys, what do we see in terms of market structure? Higher high, lower high. So we've got a high, high. So this we've got a higher high. And you're saying we've got a lower high. So on the 4 hour, we've got the start of a change in structure because we've now gone, if we were going down like this, I know this is kind of like a bit of a flat spot, but let's say we went down like this and then up. This was essentially the last period that we kind of had a swing. Even if it's that one, it's that area. And this is higher. So technically, this would have been a lower high to this, let's say, but this is now a higher high. So that's our first sign. David, nice. We've got a potential head and shoulders. Head and shoulders bloody everywhere. So what I'll do, let's say, exactly the same as John did, we draw a trend. Let's say we've got a trend, something like that. We've obviously broken the trend as well. So we're going to press play for a little bit and just see. Now, before I press play, is there any other horizontal level that we would mark, guys? I'll delete this bottom trend because it's already being broken for now. But is there any other horizontals? 55, Milan, thank you. So about there. Yep, I like that. It's a nice level that held us there as well. Coming back and tested it. It's the neckline of our potential head and shoulders. So we'll press play a little bit, see what we get. Whoop. Let me slow this down before it messes up. Our levels were good. Okay. So if somebody was saying potential head and shoulders, which is, we're obviously testing that neckline at the moment and potentially breaking. So what do we see in terms of market structure at the moment on the 4 hour? Yep, perfect, Milan, created a lower high. So we've created a lower high. What we want to do now is draw that trend line in. So we've got 1 touch, 2 touch, 3 touch technically, but we really want to see like a break and a comeback to test to really confirm that as a trend line. So we'll press play and have another look. Now, if you're trading this as a head and shoulders in the break, you're obviously trading this back down to previous levels. So we're looking at levels down here. So a potential setup would be entering the trade on the retest of this neckline. You'd be wanting to clear structure and you'd be trading down to this. Now, obviously for people in the course, why wouldn't we take this trade? Risk to reward, Milan's all over it. So we want to look for trade setups. I recommend for students looking for like a minimum of 2 to 1, 2.5 to 1 to start off with, just to give you more of a buffer in terms of the amount of trades you need to be right. If you've got a 2 to 1 that you take, and that's just saying, so if you're risking, if this is 2 to 1 and you're risking $10, you're looking at making $20. Now with something like that, it means you can be wrong 2 out of 3 times and break even. Obviously, the higher the risk to the reward, the more times you can be right, more times you can be wrong and still break even. So we're looking for this setup. Obviously, this setup doesn't give us the risk to reward I suggest. So there's no trade there at the moment, but we'll have a look how it plays out. So we broke down. Looks like we're trying to get back for a retest. We had a perfect little retest there. Dun, dun, dun. Came back to test our trend. Let's extend this out a little bit. You can see now that we're testing that trend. So now we've broken out. Now this is what we talk about when we say there's invalidations to the trade we take. So if we were looking at entering from that short on the neck of the break line, on the break of the neckline, we were trading this down with the trend. And now that the trend has been broken, this is essentially a warning telling you, hey guys, the reason why you got into this trade is starting to fall apart. Either manage your trade, consider getting out, or decide what you want to do if it does start turning the other way. So now that we've got that, we can wait a second. So if we're looking at market structure, you can see that we're still making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. This is technically a tiny bit of a higher low, but we really want to see that higher high to confirm that change in market structure. Have a look. So we come back to our levels, tested, rejected. So our levels are good. And now we've got that change in market structure. So we can get rid of this line for now. This one can go. And we just rinse and repeat. We put one line. You could put another line because we've got a bit of a channel forming there. And for the guys who have done the continuation or reversal patterns, what is this potentially? Bear flags, perfect. So if we have a look at this, and there we go. Came back to our level. So if another thing you could do is run fibs on that drop. We came back to the 0.5 perfectly, and then we just came back down. And that's your retracement. And essentially what this means is we were in the downward momentum and the sellers needed a moment to catch their breath, to take a pause, to recoup themselves before essentially pushing the move for a continuation down. And that's what this is. This is the sellers essentially getting a break and then coming back into the market. And if we have a look, we had a perfect retest of that neckline that we had. So that's the other way we could have waited for a cleaner retest, break and retest like we had. You just had to wait 8 days, but that retest came and essentially you could have traded that down. So let's see how we go with our levels. Perfect. So if you had a retest there, then you trade it down, and yeah, nice work, guys.